You need to know this before it's too late. I've seen people talk about the US debt crisis, and yet no one seems to know what to do about it. Well, economist Jim Rickards has an answer that paints a scary scenario. That's because America's climbing debt to GDP ratios being driven by our ability to print dollars, and it's a situation that could lead to a crisis of hyperinflation rather than default. This is not financial advice, but listen to what he said because I need to show you some updated figures that make these statements ring more true than they ever have before.
When I talk about debt, in particular with the United States, but you can apply this to any country, I focus on the debt to GDP ratio because you can't really talk about debt in isolation without thinking about the capacity to pay the debt. And a simple example, if you have a $50,000 balance on your credit card and you're making $30,000 a year and trying to pay rent in New York, et cetera, good luck. You're probably going to go bankrupt or at least default on that card. But if you owe $50,000 on your credit card, but you're making $5 million a year, it's, you just write a check. It's no big deal. My point is you can't look at a $50,000 debt and decide if it's a problem or not unless you compare it to the income. And if it's too low, it's a problem. And if the income's high, not a problem. So that's why you use the debt to GDP ratio. The U.S. just hit $31 trillion in national debt. That is national debt, almost all of it in the form of U.S. Treasury securities. Not all of it. There are other obligations, but mostly U.S. Treasury securities. Well, is that a problem or not? Well, one way to answer the question is compare it to GDP, do the ratio. The answer is that ratio is now a little over 130%. At the beginning of the Trump administration, it was 106%. So Trump and Biden together have taken up 25 percentage points from 106 to 131.
If you look at the total U.S. debt right now, it stands at over staggering $35 trillion, while the total gross domestic product is just under $29 trillion. And it seems like the debt to GDP ratio right now is going to remain as bad as it is now, since the U.S. Senate Committee on Budget expects the national debt to swell to $50 trillion in the next 10 years. But apart from sound bites, have you ever truly heard a solution to this growing debt crisis? The U.S. Congress has raised its debt ceiling 8 times in the last decade, which is basically just kicking the can down the road and not having any real solution at hand. But that's only compounding the problem for when it truly strikes. Did you know that in this year alone, the mere interest payments on the U.S. debt were $892 billion? That's over 3% of the total GDP and much larger than the entire defense spending of the country. And that's exactly what strikes at all arguments that suggest the rising debt is not a big deal. That's because the argument has an underlying assumption that borrowed money can be spent in a way that is productive and it can boost economic activity to grow the economy to the point that the debt becomes a smaller problem. But as the last decade shows, that's a pretty big ask from our politicians, who have been more concerned about foreign wars than the interests of the American people. As the stats show, this is not a problem that is going away anytime soon, unless there's a drastic change, of course, that either shrinks government spending or raises government revenue.
And they show that when your debt to GDP ratio goes over 90%, your multiplier of an additional debt goes below 1. So just to put that in context, at 30%, if I borrow $1 and spend $1, I might get $1.30 of growth. Assuming you spend it wisely, that's a big condition. But you borrow $1 and spend $1 and get $1.30 of growth. Okay, the debt was productive if you put it to good use. But that $1.30 gets smaller and smaller. As you get closer to 90%, it goes to $1.20, $1.10, $1.05. Past 90%, roughly, you borrow $1 and you spend $1 and you only get 95 cents of growth. You don't get your dollar back in terms of GDP. And then 90% and 85%, et cetera. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth or you can borrow your way out of a debt crisis.
So what's the solution? Both the current presidential candidates have a pretty divergent approach on how to handle the debt crisis. It's interesting when this question isn't put into more often in the media, but both Kamala Harris and Donald Trump's plans almost sound half-baked even if they're fully put into action. Trump wants to cut taxes on the rich to stimulate growth while cutting government spending on large-scale welfare programs. Kamala Harris wants to reverse by raising taxes on the rich to increase government revenue, while continuing spending on social welfare programs to create a long-term investment on the people with things like education, healthcare, and infrastructure. But growth in the United States has slowed down while government borrowing and spending has only increased to land us in this predicament in the first place. Here's a graph that shows the post-World War II GDP growth in this country. It shows a sharp decrease in the 50s after the post-war economic euphoria and boom started to wane. It fluctuated relatively stable till the turn of this century and then saw a drop in the 2000s, especially after the 2008 financial crisis. Taking the economy's rate of growth significantly up will require a lot of work and sacrifice, especially when politicians have gotten used to thinking in the short term.
There is a Keynesian multiplier, and so you can borrow $1, spend $1, and get $1.25 of GDP. That actually works. Whether it was money well spent, separate issue. Whether it's sustainable, separate issue. But you can borrow $1, spend $1, get $1.25. But the problem is there are diminishing marginal returns. As the debt to GDP ratio goes up, that multiplier goes down. So what's the critical threshold, as a physicist would say, even from complexity theory? Where is the point at which it becomes less than $1? So now you borrow $1, you spend $1, but you get 90 cents of GDP. Where's that point? The best answer is right around 90% debt to GDP. That's why the Maastricht Treaty that governs EU fiscal policy was set at 60%. Angela Merkel thought that was way too high, but it was a good cushion to 90. They kind of knew about the 90, at least intuitively. And
they kind of knew.
Reinhard Rogoff proved it, but that was their 60 is way too high because you're getting too close to 90. Well, we're at 125. I mean, who's at our lunch table? It's Lebanon, Italy, and Greece. Right? That's our crowd. So, but when you go past 90, it gets worse. In other words, that multiplier gets smaller and smaller.
Yep.
So in the fourth quarter of 2023, and I realize that's just one quarter, you need a longer time series, that number, and this is to your point, that number was 0.67. We borrowed $1, spent $1, and we got 67 cents of GDP.
And it's exactly that spiral that the U.S. is in right now. Decades of borrowing and throwing the cost of it future generations has landed us in a point where it's impossible to pay old debt back in any other way than taking on new debt, especially in a political culture where power evolves and politicians often are thinking on a 4-year span. It's very difficult to use bipartisan agreements on a plan that can last decades despite the political volatility underneath. Usually an old plan is upended by a new government after an election, which means it never even gets the chance to show the result, all the while the borrowing spree continues unabated, throwing us further down the quicksand of debt.
Well, what happens when you actually get into this situation? They say one of three things. The first one is default. So that's the Argentina case. But that's because they can't print. They borrow in dollars and print pesos. They can't print dollars, so you just default.
Yep.
And you can set your watch by Argentina. Like every 8-9 years, they default. Okay, default is one. Second one, a little fancier dress is restructuring, which is what the IMF does. So you don't actually default, but this is what they did with Greece in 2015. Extend the maturities, lower the interest rate, change the terms, smooth it out a little bit, and do a refinancing and keep going. There is no reason for the United States to default because we can print the dollars. There are consequences, but we can print the dollars. There's no reason for the U.S. to conduct a restructuring because we can print the dollars. So we don't need to do any of that. It's really for countries that borrow one currency and print another.
Exactly.
Doesn't work. We don't have to do that. So what's the third? Hyperinflation.
Exactly.
Then that's the American way.
I think this conversation reveals that the economic problems we have right now are born out of a failure to find long-term political agreement on the economy. But unfortunately, that might become indispensable as the cost of delay gets higher and higher. If you look at what's happening on an international scale with the BRICS alliance and the danger it poses to the US dollar's global hegemony, you realize that we may not have a lot of time left to come up with a solution. Let me know in the comments if you agree, because this crisis of debt demands our bipartisan attention before it's too late.